estate and gift tax, the new law they passed, and that would be the American, what's the American
Taxpayer Relief Act. Okay.
And this was passed in 2012, but nobody really heard about it.
No, this was, I think it was right at the beginning of 2013.
It was brought up in the end of 2012, and then it was finally signed in January of 2013.
Right.
And what's unique about this is that given all the rhetoric that's come out of the administration about the rich people have too much money and this actually helps people that have money. Can you tell me what it does?
Well, okay, we had the Fiscal Cliff. So it was kind of a showdown of all the government. And at that time, we had a lifetime exclusion of $5.12 million, right? Now, what they were saying, if this runs out, okay, then it's going to revert to a $1 million exclusion, and everything after that's going to be a 55% tax, okay? So that would be, you know,
pretty substantial.
Pretty substantial.
Very substantial.
Changing from 5.12 million. Okay, so let's talk about what that 5.12 million exclusion is. That means over your lifetime, you can gift that much to donees. Okay, over your life, it's a lifetime exclusion. Okay, so that was going to go down to $1 million, which would be huge in a lot of cases. But instead, it went up to 5.25 million. Basically, you know, taking account of inflation, I guess, are being bumped up a little. And if you go over the 5.25 million, then you have a 40% tax.
Okay, so if your tax basis for an inheritance tax is over 5.25 million, or you burn the exclusion, then everything's at 40% tax. That's gone up. Yeah. That's more than it was before. It wasn't at what was it, 20%? Because it went up substantially. That's because.
Yeah. Well, anyway, right now we're at 40%, and but there are still some saving graces, you know, in addition to the 5.25 million. If you with your spouse, there's unlimited deductions for transfers between spouses.
Oh, okay.
Why the spouse is alive. Okay. And so your estate and gift tax are kind of held down as long as that spouse is alive. So you can do transfers as long as that spouse is a U.S. citizen.
Okay, so what you're saying is the spouse can actually use some of the exclusion for their spouse. Say husband, wife, they both have the 5.25 million exclusion, correct?
Well, they can do a transfer during their lifetime.
Right.
That, you know, that gives them relief until that spouse dies. And then you have to get down to the brass tacks of how much is left. Now, there's another thing that's a little bit more complex.
And what is that, Mark?
That's called portability.
Okay. Can you explain that to our audience? Portability sounds like something you don't normally throw into a tax code.
Okay. So you can add the unused portion of your spouse's exclusion to your own. So you could actually transfer, you know, that 10.5 million onto your descendants or your beneficiaries.
You mean your beneficiaries, from your estate can actually inherit that?
As long as you handle everything very carefully. You have to file your tax return within 9 months, and you have to be very careful, you know, after the death of the first spouse. But you can recover that 5.25 if it was unused.
Well, you know, that's pretty exciting in many ways, because there are a lot of families. I'm sure there's up to 5% of the people in the country could actually utilize this. I know that it's not. There's the vast majority of people who can't use this because that's a lot of money.
Right.
But with the idea of portability, what you're saying is, technically speaking, you could have one spouse left with $10.5 million with exclusions. Is that correct?
Right.
So that means if they have beneficiaries, they could literally give away the $10.5 million, and there'd be no taxes on those gifts.
No estate tax.
No estate tax on those gifts.
Yeah.
But doesn't that take away from what the estate tax has been really promoted over the years? Is that, you die, and so you're supposed to give a bunch of your money back to the government because you got to help the rest of the country. Well, there's
other ways. We're not going to get into the intricacies of it, but there's ways that you can run into other taxes as well. But in the broad brush, what this does, you know, starting the beginning of this year, is that you have, you know, transfer between spouses, you have portability, you have goes up to 5.25, and there's one other issue that came up. You can give $14,000 a year per donee as a gift.
So
that doesn't go into your 5.25. That doesn't go into your lifetime.
Okay, those are the gifts that you can give out every year to any number of people that you want to give $14,000, and those don't add against the 5.25 million.
Right.
Okay.
And also, if you're married, that could be $28,000 per year per donee.
Well, let's go back for a minute. The Bush tax cuts that everyone keeps complaining about included the estate tax, where they effectively wiped it out, said you're not going to have to pay estate tax anymore because they didn't believe that that was fair for the people that were transferring wealth between generations. So now we're back up to 40% above 5.25 million, which effectively covers the majority of the people in the country, right? Okay, so but that 40% for the people that are above that amount, that sounds like a lot of money, Mark.
Yeah, well, there may be other things you could do. You know, there's other things. There's other mechanisms you could use. You know, there's you know, family limited partnerships. There's trusts. There's different things you might be able to do, but in general, that's about you know, that's what you have on your exemption or your exclusion is your 5.25 million.
Well, you know, the interesting thing is the Rockefellers, the Kennedys, and families like that have been utilizing trusts and limited partnerships and all that for generations with their offspring, because in fact the money may have been earned 50 years ago and now we're talking great-great-great-grandchildren are getting the benefit of their income from that long ago through vehicles where there's not really taxes paid, there's no reduction in the principals, and possibly, you know, if there's an estate tax code, you would think that some of that would be drawn off. But that's what people always talk about when they talk about estate tax, the very wealthy.
Well, I'm just saying that you know, you're not necessarily going to be immune from taxes. I mean, you're gonna face tax liabilities no matter how you handle things. But there's some ways that you can do it to improve the way that it goes forward. For example, you know, your normal estate plan is going to include maybe a declaration of trust for, you know, if you're going to do a trust, you know, a pour-over will, you know, a durable power of attorney or a springing power of attorney, you know, advanced health care director. So you have an estate plan that can kind of, you know, do the transfer. At least you avoid probate, and you know, makes that process a little simpler too.
Yeah, well,
but you always have to deal with taxes.
Well, isn't that kind of the main rationale behind trust to begin with? Is to ensure that you can pass the race of the estate to the beneficiaries with as limited taxes as possible?
Well, it's more to avoid probate. Yeah.
Well, there's probate fees that go along with that, and probate.
So if you can, because you know, if you go through probate, you have an executor, right, and then you have an attorney, and they're going to get a statutory amount, you know, of fees through that. Right. And also, it's a long, involved process. Right. With a trust, you don't have to pay for the executor, you don't have to pay for the attorney, not the statutory fee at any rate, and the process is a little more streamlined. Okay. But what you're doing is you're lining it out a little more carefully, so there's not as much, you know, the declaration of trust kind of lines out a lot of things that get decided as you go through probate.
Okay, well, on that note, I think we're going to be done with the show tonight, and I wanted to thank you for joining us for Law Talk, and I'll tell you, for Mark and myself, James Barrett, I will wish you a nice evening. And so what about this probate anyway?
Well,
there's statutory fees with probate, and who makes the money on that? Is attorneys. And you know, I've done probate. You've done probate.
There's also the executor, too.
Yeah, and executor gets executor fees.
But I think the executors work pretty hard.
Actually. Well, if they follow